Welcome to The Explainer. Today, we are breaking down an absolutely standout quarter from the off-price giant TJX Companies. In a retail environment that's filled with all kinds of uncertainty, TJX just came out and delivered results that sent a really clear signal to the market. So, let's dive right in. So, the big question on everyone's mind heading into this earnings report was tariffs. With costs going up everywhere, how could an off-price leader like TJX possibly protect its margins and still give customers a great deal? Well, turns out they had an answer, and wow, it was a powerful one. Let's start with the bottom line, earnings per share. It came in at $1.10. Now, that's a full 9 cents ahead of what Wall Street was expecting. That's not just a beat, that's a significant beat. It points to some serious underlying profitability and, get this, it represents nearly 15% growth year over year. And the strength didn't stop there. Look at the top line. Revenue hit $14.4 billion, which blew past expectations by over $250 million. A solid 7% increase from last year just goes to show you that people are walking into their stores and they are loving the value they find. So, a beat on the top and bottom line is great. We love to see it. But the real story, the part you really want to pay attention to, is how they did it. To really get that, we need to pop the hood and look at the company's profitability and what was driving all this growth. Now, this slide is where things get really interesting. What you're seeing here is just incredible operational efficiency. Their pre-tax profit margin expanded by 50 basis points to 11.4%, which was way better than they had planned. Gross margin ticked up, sure, but look at SG&A. That's their selling, general, and admin costs. They actually decreased as a percentage of sales. This shows TJX isn't just selling more stuff, they're getting smarter and more efficient at the same time. For an operator, that's the holy grail. And this growth wasn't happening in just one little corner of the business either. As you can see right here on the chart, performance was strong pretty much across the board. The core Marmaxx division grew a solid 3%, but then we saw even stronger results from home goods at 5% and just an exceptional 9% comp from TJX Canada. The big takeaway here is that the main driver, more customers walking in the door, was happening in every single one of their divisions. So we've seen the impressive what, but now let's get to the how. How did TJX manage to navigate this minefield of tariffs and still put up these kinds of numbers? Well, the answer is baked right into the core strengths of its off-price model. The crucial thing to understand is how they launched this three-pronged attack to just completely neutralize the tariff problem. First, the availability of great brands was, in their words, fantastic, so their buyers went on the offensive. Second, their massive global buying team can pivot on a dime, sourcing from over 21,000 vendors to avoid categories getting hit by tariffs. And third, their pricing is flexible and surgical. They keep a close eye on competitors to make sure they always have that value gap. The result? They completely offset the tariff pressure, keeping their merchandise margins flat. That is just masterful execution. Now look, a 14% jump in inventory at another retailer, that might look like a huge red flag. But at TJX, it's a sign of pure confidence. They saw what they called excellent buying opportunities out in the market, and they just loaded up. This is an old, stale product. It's a strategic move to make sure their stores are packed with fresh, exciting finds for the super important second half of the year. And that operational confidence was echoed by the management team on their call. CEO Ernie Herrman was all about the future, emphasizing a long runway for global growth. That's exactly the kind of forward-looking language that gives investors confidence that goes way beyond just one good quarter. Of course, a strong quarter is one thing, but what really moves the stock is the outlook. So let's take a look at the guidance they provided. So after that big Q2 beat, management raised its full-year guidance for earnings per share to a new range of $4.52 to $4.57. They're projecting solid 2 to 3% comp growth for the third quarter, and now they see 3% for the whole year. This basically signals that the momentum from Q2 was not a fluke. They fully expect it to continue. All right, so that covers the quarter and the updated guidance. So let's put this all together into our key takeaways. What should investors be watching for from here on out? First, keep your eyes on those margins. TJX has proven they have the playbook to manage tariffs, and we expect that to continue. Second, that big strategic inventory build is key. It positions them perfectly for a very strong holiday season, and honestly, we see a real possibility of them beating their implied Q4 guidance. And finally, we expect to see analyst price targets move higher. As they update their models to reflect this new level of margin strength, the stock's valuation case just becomes even more compelling. So our final verdict is crystal clear. We are reiterating our outperform rating on TJX. Their execution is nearly flawless, and in this kind of volatile environment, their value-driven model is just set up perfectly to continue gaining market share. The only real question left is, as other retailers struggle, just how much of that market share is really up for grabs. And as always, just a final reminder, this explainer is for informational purposes only. This is not financial advice.